All right, Bulls and Bears, we are back. It's good to see you. It's good to be back with you here again. BX4, Bull to the bus, ride the bull, prepare for the bear. Back with another dose of economic reality. Let's go ahead and get right into it. The powers that be, the bankers, the money printers, still hard at work keeping this quote unquote economy growing. And how is that done? Well, that's done by allowing people to go further and further and further into debt. We're going to talk about the banks today. We're going to talk about the debt levels and how banks are loosening instead of tightening. You would think they would be tightening right now with delinquencies rising. They're actually loosening the lending standards. We're going to get into that. We're going to show you some charts. We're going to talk about the Fed funds rate and how every time the Fed has lowered rates from a increase or from a hiking cycle, we've seen a recession follow. Could this be different? We've heard the term this time it's different. Maybe it is. And maybe the different is much worse. So we're going to get into that, folks. A lot of other news. Please make sure you're subscribed. Let's go ahead and get right into it right here. First of all, here, of course, it's being reported to expect a record holiday spending season. We hear this every year, folks. A record. And it's like a broken record because we hear it every year. Holiday spending projected to hit new record. Holiday sales growth expected to slow to 3.5%. That means people are still spending more versus the previous year. It's a new record, but the rate of growth or the increase in the debt that people are taking out is slowing down. So, folks, that's the name of the game. It's all about the lending. It's all about the banks, keeping the banks liquefied, deregulation, allowing the banks to loan out money they don't have via a digital fiat currency, which is not really currency. It's just digits on a screen, but that's where we're at right now in our monetary system here. But let's talk about what the banks are doing. They're keeping the economy going just as we predicted here. We said the banks are going to probably loosen as we go into the end of the year. And of course, now we're in the fourth quarter of the year. And let's bring up a chart here on this to make it very simple and show everybody what's happening. This is the percentage of domestic banks, U.S. banks, that are tightening their credit standards, right? We saw, of course, the big tightening cycle there ramped up to about, 60, almost over 70% there, 71% on the onset of the health crisis, 2020. But of course, what do we see? We saw a big drop, and banks actually more than made up for the tightening they did. They loosened more than they had in the previous, 8 years, right? And that's how we saw this inflation explode and the cost of living explode, the cost of everything basically explode on top of people not having to pay their rents, not having to pay their mortgages, and stimulus checks and everything else under the sun to stimulate the economy. So banks loosened like never before. They started tightening again going into 2023. But just as we predicted right here, I said they're going to try to keep this economy looking very good. Banks are going to continue to loosen, and they did just that here. And of course, we have the numbers for the third quarter. It dropped from the second quarter. We only have a little, actually right now we're at 20%. And I think this month it even got lower than that. I think we're below 20%. But at the end of the third quarter, we're at only 20% of banks actually tightening, meaning more money, more debt, more quote unquote economic growth. Economic growth, also known as debt accumulation. That's the name of the game, folks. But we've got people out there from the Fed. For example, the Fed's daily says the central bank is on track for more rate cuts. Do you get it yet, folks? They're making it as easy as possible for people to take on more and more debt. And when banks are willing to loan out more money and allow people to go further into debt, it's much easier for people to carry the debt. For example, you've got a lot of people right now, I'm not sure if it's a record, but it's pretty close to a record, people doing balance transfers from one card to another because they can't pay it off. So they get a low introductory rate for 10 months, 12 months, maybe 18 months. And people are playing this, what word can you use? Shuffling, debt shuffling, shuffling of the debt or moving around the debt, consolidating debt over here, over there. We're seeing now an uptick in home equity lines of credit. And when it comes to real estate, we don't see as many people own their homes as we did before the housing bubble 1 went bust. So that's why we're not seeing foreclosures really ramp up, because we have more big money, billionaire Wall Street investors that own homes now versus back then. Remember, the home ownership rate is much lower. That's why you're not seeing a spike in foreclosures like you did back then. On top of the fact that the banks are not tightening, most banks still actually loosening their lending standards, right? So I want everybody to be aware of not just what's happening, but the reasons things are happening. Tons of channels can read you the news. They say this is happening, that's happening, home prices fell, prices of this went up, prices of this went down. Here's what's happening with the funds rate. But are they telling you why it's happening? Are they giving you the mechanism behind it, folks, the money system, right? That's what we specialize here, not just the news, but what's causing the news to take place. Well, something that's causing a lot of stores to close is the levels of debt that people are in. Yes, they can still transfer their balances from card A to card B, but when it comes to spending, look what's happening with Walgreens. 1,200 store closures. Things are expensive at Walgreens. I went into Walgreens for a few things, and it seemed like it was double of what I could have got it for at the other wall. Not Walgreens, but Walmart, right? Wall to wall. Walgreens is expensive, folks. 1,200 stores closing, hoping for a turnaround. When you add on top of that the theft and the shrinkage is what they call it, not much of a chance for these stores unless they get some really good security people to stop people from taking stuff. Remember the story I had from my Walmart here, or actually one city over from where I'm at. We have like 5 Walmarts within like 6 miles here where I'm at. One over in a city called Santee. A guy was walking me back, an employee walking me back to the casing where everything's locked behind a case. It was like a air pump that people use to pump up like inflatable toys and pool toys, stuff like that. He got out this $18 pump, and on the way back there told me that his location, that Walmart, had lost $1.5 million in 1 year. That was actually 2023. $1.5 million just at that location in theft losses. All right, so they're locking up more stuff. They're having to raise prices. Walgreens locking up tons of stuff. I've seen some videos of some pharmacies, including Walgreens, with more than half of the store locked up behind glass casings. Man, pretty insane, folks. But 1,200 stores closing. That's going to be a lot of people losing their jobs. But let's talk about what's happening with the Fed. The Fed, as we just talked about, cutting rates. We got the Fed's daily out there. Central bank likely for more rate cuts. Most of the people at the central bank agreeing that the economy needs rate cuts. But remember, the consumer is strong. So if the consumer is strong, why do we need rate cuts, right? But let's talk about what's happening now. Obviously, the Fed are cutting rates. Well, look what happens every time rates are cut from a hike. So we have a rate hike cycle, 2000, rate cuts, recession followed. See in the dark shaded area. Of course, financial crisis, hike, cut, recession followed. Hike in 2019, and then a cut, recession followed. Now, of course, everybody blames that on the health crisis. They don't blame it on the monetary system at all or the levels of debt. They blame it on the health crisis. That's basically the scapegoat for everything bad that's happened. Inflation, the levels of debt, everything. We had to do it. We had to go into debt and have inflation because of the health crisis. Here we are again, folks. Will it play out differently this time? And keep in mind, this hike in the Fed funds rate is much larger than we saw both in 2019 and before the financial crisis and before the dot-com bubble. You'd have to go back pretty far to see a rate hike as big as this one, from the funds rate of 0 basically to over 5%. You'd have to go all the way back to looks like the 80s, unless my eyes are not working right here. I've got glasses, so I think I'm looking at it pretty clearly. And if you're not looking at this, if you go back to the 80s, we had funds rate at about 4.6 in the late 70s, had to spike up to almost 20% Fed funds rate, folks, in the 80s. And guess what? A recession followed. And of course, they cut rates then, down from almost 20 down to 8%. And the rest is just a downward trend. But this was a big one, folks. This is a big rate hike. We haven't seen the fallout like many people expected and predicted with People predicted massive foreclosures. I was one of the only channels to say, no, there probably won't be because so many Wall Street firms now own so much of the real estate. And it varies from state to state. If you look at California, the home ownership rate here in California is only 50%, meaning the other half of the homes are owned by Wall Street and other investors. So pretty amazing when you think about it, how a lot of people really can't figure this out, but it's pretty simple when you just look at the basics and the facts here. But what's going to happen this time with now cutting rates? Will we see another recession? And we're more than halfway now through the month of October. So will my prediction of an October shock or a red October come to fruition? Right? If not, we're going to find out in a couple of weeks. You guys can all make fun of me and beat me up down in comments, whatever you want to do. But it'll be fun, but it'll be interesting to see what happens in the next couple weeks. October historically is a pretty big month for market corrections and market shocks. And I think there's a lot of things at play right now. If you've been on this channel, there's so many things right now that are potential brick walls for the economy, the banks, normal functionality of everything, the supply chains. When you look at what's happening globally, the conflicts, the U.S. involvement now in all these conflicts, a lot of hostility, the BRICS nations. Meeting coming up here in about, a week, starting on about the 22nd. It's going to go through the 24th. We're going to see what comes out of that. Will there be a financial shock evolving from the BRICS nations? Will they dump a bunch of U.S. debt in sort of a sneak attack against the U.S. and the U.S. dollar? We're going to find out, but I see a lot of potential big things that could play out here in the very near future. Not next year, like some people are saying, oh, it'll happen sometime. I'm saying very, very soon, folks. And I'm kind of painting myself into a corner or going out on a limb, so to speak, by saying that, because when you start putting timelines on things, you start setting yourself up for embarrassment, right? So maybe I'll be embarrassed. Why is that? Why have so many people predicted things that were going to happen that didn't happen, right? Again, people predicted the housing market to come down many years ago, right? When home prices surpassed the home prices from the 2008 housing bubble, people started saying, okay, they're going to crash. They're going to crash. They're going to crash. But they didn't look at all the fundamentals, and they didn't look at all the factors that are keeping prices elevated. That's what we do here on this channel, folks. That's why you're here, I think, right? So we're going to see what happens. It's going to take something big to derail this debt system, this new debt, people borrowing money, banks loaning out money. Again, back to the beginning of the video, banks not tightening. Only 1 in 5 banks, 20% or so, are tightening, right? From a historical standard, that's very low. So even though the debt levels are enormous and we're having to cut rates, banks are still keeping the lending going. That's why they're fighting against the new bank regulations. In fact, there's some news out here. We're told that the earnings are strong, the banks are fine, they're well capitalized, they passed the stress tests. Regional banks brace for tougher capital rules, but they're getting relief from the rate cuts. Right? So regional banks, why are they bracing for tougher capital rules if the banks are all strong and if the banks are all able to withstand this financial storm? Look at this here out of the cool down. Here's how they put it. New report reveals massive potential losses for America's financial institutions. You are talking about potential bank failure. That's one way to look at it. Other people say no matter what happens to the banks, they're just going to get propped up or bought up by a larger bank that's too big to let go under. You know what I mean? Consumers worry about debt delinquencies. That's on the rise. Consumers' worries about debt delinquency are on the rise. Again, so if everybody is doing fine, the consumer is strong, why are consumers worried more now about delinquency than before? Right? That's how it was put out at Investopedia. CNN even is writing about this here. Americans haven't been this worried about making their credit card payments since the pandemic. What's going on, folks? Well, what's going on is record levels of debt, people robbing Peter to pay Paul, working record levels of extra jobs or second jobs or side hustles, working a lot of hours, folks, just to make ends meet. And a lot of people still getting further into debt, even working very, very hard. People in their 60s and 70s still can't pay off their student loan debt. We talked about that, maybe 4 or 5 reports ago. It is insane, folks, and it doesn't end well. They're doing everything they can do to keep kicking the can down the road. Are they running out of road, or are they finding new ways to pave new road? I think they're finding a lot of new ways, right? Not really new, but they're doing things that nobody ever thought they would ever do. No one thought that with price levels where they're at right now, especially in real estate and price at the grocery store, no one thought a couple years ago that the Fed would be cutting rates, but that's where we're at, folks. And, it's pretty simple to see what's happening here. Let's talk about this here. New York Central Bank sees 4-year high in consumers that are expecting to miss their minimum debt payment. A 4-year high, folks. So we're at a crossroads, right? So it should be clear now with the position that people are in with these levels of debt. It should be clear why we're cutting rates. It should be clear why banks are loosening the lending, not tightening, but loosening, even though they're supposed to have tougher capital requirements. That was supposed to take effect here at the beginning of October. Now, the chart that we looked at the beginning that showed the number of banks loosening, that was only up until the end of the third quarter. So that was only the end of September. So we're yet to see what's going to play out here. Will it happen before the end of the month of October, with October 1st being the higher capital requirements in place for the banks? Or will they just turn back, do a 180 and say, sorry, the banks don't have to have capital rules. It's too bad for the economy because it restricts lending. And of course, without lending, this whole thing comes to a halt, and not just a halt, it comes crashing down. So there's got to be a continuous flow of money. That's why you have no backing of the currency since the early 70s. That's why you saw inflation take off, especially since we came off that gold standard in the early 70s. Folks, that's where we're at. What do you think about all this? What do you think about the history of recessions after rate hikes and then cuts? Is it different this time? You let me know down in comments. I'd love to hear from you. I'll be off work for a few days here, actually. So be reading your comments more than usual. Maybe try to interact with some of you down there. I appreciate every one of you and your support. Shout out to a few people that have given given support to this channel. Sorry, folks. It's late for me. I'm actually recording this at night. Shout out to a few people that have supported this channel. People have supported me with your tips and super thanks. Thank you very much to Julian61983. It's a screen name. DJ Jojo back in the building. DJ, hello. Thank you for your support. Multiple times, actually. Maria Rivero. Got to get caught up here, Maria. Thank you. Julian61983 again. DJ Jojo again and again and again. Pedgman Gill, 3495. Thank you for your support. I appreciate it, everybody. Thanks for being here. Please hit that subscribe button if you're not subscribed. Very important time to be following every turn of this economic winding road. And we're going to see what happens here in the next few weeks. Critical time to stay ahead of the financial curve. Make sure you come back to this channel. Make sure you're subscribed. Hit that notification bell. Very important times here. We're going to see what's going to happen. Will my predictions be right? Also, let me know what you think about that down in the comments. I'd love to hear from you. Talk to everybody very soon. As always, keep stacking. Bye for now. Big love and peace.